Hello, everyone. Welcome back to another episode of Test, Optimize, and Scale. Have ClearingBid here today, the world's only IPO network. Met at investment crowdfunding events, going to be talking about public markets, going to be talking about issuers, investments. I think you'll be very impressed with Matt and Kayle's background. Going to get into that in a moment. But first, Matt, Kayle, founder, CEO, Matt Venturi, Kayle Watson, head of BD. Thanks for taking the time to join the podcast here.
Thanks for having us.
Thanks, Jason.
Excited to have you gentlemen on. Always enjoyed discussions with you. Thought we could begin with your backgrounds. Matt, if you want to kick it off and familiarize us a bit with your history.
Oh, thanks, Jason. Well, it's great to join you. And Kayle and I are really happy to be a part of the podcast. We respect your efforts and your success, and having had the affiliation with the Professional Crowdfunding Association has been a good one too. So this is near and dear to our heart. We appreciate the opportunity. I hate to admit I'm a 40-year veteran on Wall Street. I started my career with Merrill Lynch back in New York. It was a corporate intern program where there were 17 of us that spent 2 months in each area of the firm over 18 months. It was a great indoctrination to Wall Street. I went to NYU Business School at night while doing that. And then I had the benefit of becoming a retail broker of all things while still going to NYU. And in retrospect, for what we're doing now, that really plays well. So that was for about 2.5 years till I finished my MBA. Then I moved to the syndicate desk, pricing investment grade debt issues for a year with Merrill Lynch. Left, joined Smith Barney, became Solomon Smith Barney in investment banking, 12 years there. 4 of those doing financial restructurings and bankruptcy advisory. Then went off on my own, set up a boutique investment bank, and then got recruited by Houlihan Lokey, Howard and Zukin to help build their investment banking efforts from this 98 to 2002. But back in sort of mid-teens here is when this concept really evolved, and we'll talk a little bit about that. We've been doing ClearingBid now for a little more than half a dozen years, and it's taken a little time to change Wall Street, but for the better. So we'll talk about that too.
And that's right, ClearingBid award winner at the CFPA Crowdfund Professional Association Summit. Kayle, want to kick into the bio, the background, the history?
Absolutely. Again, and I want to echo Matt's thank you for inviting us to attend to join your podcast. It was great meeting you at the Crowdfunding Professional Association and have the chance to get invited to join. It was a first podcast for us, so it's great to be here and to join you. I've got not as many years as Matt. I've got 28 on the street. My background is a Naval Academy, studied engineering. I spent 3 years on a naval destroyer running the engineering department, supervising about 180 men. I switched and became a Navy SEAL, went through BUDS training back in 1989, did 2 platoon commander tours, and then I went to Wall Street. I've spent 8.5 years at Bear Stearns as an equity sales guy covering hedge funds and asset managers, insurance companies, and moved on. Dana Telsey's firm, the first analyst to launch her own firm, was head of sales for her. And then I went to Guggenheim Partners, back to a traditional firm, 4 years. And then I moved to BlackRock. I got a chance, 8 years at BlackRock. When I joined, they were at $800 billion in assets, just approaching $1 trillion in ETFs. When I left, we were at $4.5 trillion. I was brought on board to help institutionalize and use the ETFs. So it's amazing to see the growth in that space. And I really wanted to do something different. I went and I spent 7 months at a crypto firm. It was early. They were trying to launch the first Bitcoin product, delayed by 2 years, so it didn't make sense to have a head of distribution around with no product. And I got introduced to Matt, and we had a couple really great phone calls, and asked me to join the team and partner and help them revolutionize Wall Street with IPOs and debt offerings. So I've been here now 3 years, and we're thrilled to see this get going.
Revolutionize Wall Street. It's a big lofty goal to go after. What does it look like for you guys? What was the creation of ClearingBid to be able to revolutionize the street?
Well, that's a great question, Jason. So, getting back to the background, having spent a couple years as a retail broker during my career, and then getting investment banking and syndicate background, it really came to the awareness that, there's such a disparity between and how the Wall Street sell side works and the different interests, really conflicts of interest. There's a lot of dynamics that go on that people really don't appreciate between the retail, the institutional, the syndicate side, the corporate finance, the issuer's interest, the institutional buyer side. And they're all kind of really working against each other. And the ones that really get left out is the mass public. And so kind of looking at sort of that background and having been a salesman for a while, and how, I never got access to IPOs as a retail broker at Merrill Lynch. Fast forward today, we've got, large firms out there with retail investors as part of it, and really driving a lot of this investment momentum, who are shut us process too. So we looked at kind of, the dynamics there, and ran across one individual who's really been instrumental in our efforts. His name is Roland Tabell. Roland was president of OMX. He had about 600 people working with him when OMX was acquired by NASDAQ, really for their technology backbone, and kind of looked at this and ended up filing our first patent. And this is going back to 2014. But what we really did, and a little bit of luck and a little bit of a skill here, but looked at just plugging into the existing infrastructure to be able to follow those same pathways to be able to put orders in for IPOs. And we could talk a little bit about that. But that was the impetus to say, hey, look, let's open it up to the masses. Let's level the playing field. And then the ability to have some price discovery tools and some other things we can talk about really just creates, we think at this point, an alternative that is really the only way companies will go public down the road, once we're in the market and able to demonstrate this alternative.
If I could add one more point, Jason, it's really interesting. People think today in the IPO, everybody wants to get in an IPO. Really, only about 8% or so of true investors get to participate. And that's the big hedge funds, the big asset managers, the big, for better sake, trading partners of the large firms. So besides the retail, which is millions of investors, there are a lot of institutional investors who don't get to participate, because if they don't do enough business, they're not really going to get access to IPO. So we really open this up to the other 90, 92% of the market who don't participate today. And then it's done in a transparent and fully democratic manner. So everybody is treated on an equal footing. So whether you're, a widow, an orphan, or a barista working at Starbucks, you're treated the fair and same process as if you're one of the major, Fidelity, Magellan's Asset Management, T. Rowe Price, or Wellington. Everybody's on an equal footing.
I love it. Matt, your experience over 40 years, retail broker, syndication, understanding the street. Kayle, everything you were doing, building ETFs, working on Wall Street, understanding what's possible at the volume of retail. You looked at the market and said, hey, these IPOs can really use retail investors, millions of investors. Why is it just this 8%? Why is it the same people at the same table? Let's bring, I use the word the crowd a lot in marketing, but let's bring high volumes of retail investors in and really have more activity across each of these IPOs, have people have more impactful launches as a whole. And what about the IPO system today? I've heard different comparisons to 5 years ago, 10 years ago, 20 years ago. What is the state of an initial public offering in the space today?
I'll jump in with something real quick, and I'll let Matt take it over, because he's the CEO of this phenomenal opportunity with ClearingBid. When I joined Wall Street in 1998, before the internet boom, people paid 6 to 8 cents a share. Everything was done the old-fashioned, still the old same way, right, for 50 years. The internet has changed everything. Technology has changed everything. You now have people paying for order flow or trading for free. Big firms are trading for fractions of a penny. The internet has radically changed everything. Guess what is not? IPOs are still done the same way they were when I joined Bear Stearns in 1998. Wow. It's for a reason.
Yeah, and to Kayle's point, it's almost 100 years is the same way. It's never changed. And what happens today is, back to this 8%, is probably even lesser than that in terms of who really participates, is the lead manager who's managing the IPO. They're making all the decisions. They're making decisions in terms of who to market to, ultimately how to price it, and what those allocations are. And the reason why they have so much control is because the institutions who are on the top of their customer list, who are the ones they're really servicing and addressing, as opposed to necessarily the issuer and the issuer's interest, quite frankly. But those large institutions, they end up designating, or if you will, giving their orders to the lead manager, and giving them the commission, if you will. They call it the selling concession, because they want the allocations. And so it's all quid pro quo. And so that's why everybody else is left out of this process, because there's a very controlled channel of distribution and pricing and allocation that takes place at really the expense of everybody else. That's where these inherent conflicts of interest occur. And by the way, these are indications of interest that come in. They're non-binding. At the end of the day, every institution doesn't get anywhere near the fill that they would like. And then consequently, issues are underpriced. When they first trade, they typically trade up on the first trade. And then everybody else who would have loved to have the opportunity to participate are in there buying shares at a much higher price. Company leaves money on the table. Real investors who want to buy, own, and hold for the long term are paying a higher price. And you have this huge dislocation that takes place.
There's two other groups I would like to also point out who don't ever get to participate, who would love to. So when a company's going public, one, their employees. So you may have a large company and, they may want their engineers or their sales team or people that actually work for the company, have been there for years. They don't ever get to participate on the IPO these days. They can't buy stock. They have to wait. And the second is customers. So all the people who buy your product, your clients who want to they've supported you for years, they're cut out of it too. With the platform Matt has built, they all get to participate. So it's open to everybody.
They get to get involved. They get to buy when it's underpriced versus when it's at a higher cost. And I think we've seen what happens once it gets to a higher cost, not always sustainable after that initial public offering. Let's talk more about the platform. What's been built? What does that mean for issuers? What are the value points to investors? How does that democratize the access to these deals beyond just the lead manager and the controlled channels and the institutions? What's now possible for the issuers and the investors today?
Well, historically, there's been no practical way with which to reach these investors in a broad sense. And again, the reason being, there's no way for them to put an order in. Yeah, you might have, among a syndicate of selling group members and an underwriting, their names on the cover of the prospectus, but they're not able to put orders in because the lead manager's not taking them. So what we've done here, Jason, is we said, look, let's follow the same pathways as how secondary market limit orders are submitted through brokers. Brokers, we feel this, like we call them our distributed sales force. And it's not just brokers, but it's also the registered investment advisors out there who are managing assets on behalf of investors and allocating those assets among different, types of asset classes. But at the end of the day, they're shut out. So what we're saying is, look, let's bring them to the party. And the way we do it is we allow every single selling group member, including the lead manager, to be able to put an order in a seamless, ubiquitous way, just like they're sending an order to the exchange to buy 500 shares of IBM at a limit price. And by being able to follow those same pathways, it's over what they call FIX, Financial Information Exchange Order Entry Fields. It's the way every secondary market is submitted. Every broker can do it. The brokers, by the way, are really important because they have to know the customer, they're determining suitability, have to make sure it's appropriate for the investor. So they're providing that investor protection, which FINRA wants to see, and we're a compliant FINRA broker-dealer, and the SEC wants to see. So we engage that selling group to participate and allow every investor to put the order in, and every order that's submitted is recognized and in that order book.
One of the things that, and Matt can talk to this longer because as he told you earlier, he's been really working on this for a while. And to change Wall Street, it's pushing a boulder uphill. But there's 5 constituents when you ask, how do we benefit the issuer, et cetera. We have helped everybody in that ecosystem. The issuer gets to maintain control now of their deal with the lead manager. They get to help determine where the pricing is based on the market. So they always say the market tells you, the market knows best. So the market on an auction is going to tell you the best price. So they're going to leave less money on the table. The syndicate, everybody becomes an active seller. So they now get to be rewarded and the entire group is out selling the deal. The regulators like this because it does everything that they want. The institutions like it. I think the lead manager and them will actually like it. It can help them better price the deal. And then the investors like it because they now get to participate in an equal footing, which has never been the case before.
Yeah, exactly right. And, again, looking at this distributed sales force, they can earn the selling concession, which is a big incentive. And it's not coming out of the customer's pocket. It's coming out of the gross spread or the placement fee, if you will, that the issuer pays to the underwriters. And we really want to preserve that underwriting fee. We don't want to compress it. Some of the entrants in this market earlier have compressed growth spreads and tried to take the sales force out of play. That's not the right strategy. Pay the salespeople for doing what they're doing, what they're supposed to do. Engage with the client. But at the end of the day, you're really just you're renting that distribution without a fixed cost for each underwriting that takes place. And back to Kayle's point, we're really benefiting every constituent in this whole process without picking anyone's pocket, but creating a much more open, level playing field to affect better execution.
I like that word, better, better execution at that. Like you said, this has been done the same way for so long. You're building off of that. You're keeping those same, margins in there. It's then attractive to the brokers, but it's giving access to these growth stage deals, at the right time of IPO for their investor base, for their client list. And then, of course, the issuers, the access to capital and from a higher volume, not just a few groups. Have you been getting a strong response from the street? A lot of strategic partnership opportunities? How's that initial feedback been?
Honestly, the feedback has been very positive, but I think the general consensus is this is a heavy lift because other folks in the past have not been successful for reasons that we can discuss. But I think we've worked around virtually every one of those points of pushback. So the consensus is, hey, look, once you get your first couple deals done, it's all over with the shout, and this is the way that it'll be done, and we're in. That's what investors say. That's what issuers say. The regulators actually embrace what we're doing because we do, address we address investor protection, addressing fair, orderly, and efficient markets by minimizing that volatility, and we facilitate capital formation. Those are really the three underlying tenets of the SEC's mission statement. So, that's good. But we're checking every box out there. But this proof of concept is you heard Kayle's and my background and the team's background. We're veterans who've been around. We understand this. This is not like introducing some app with a technology, solution. It's an infrastructure play, and it's improving upon what already exists, but leveraging it in a way that brings it in the 21st century. And people look at it and go, man, it's never been done before. Who's to say you guys can do it?
The other really interesting point about this, Jason, is it's not risky because it's not new technology. So it's
Yep.
a new process. It's thinking about primary shares on a secondary market, but that fixed infrastructure that Matt talked about is used for hundreds of millions of transactions a day. So it's used every day. It's same thing. So it's not risky. It's just new and revolutionary because it's thinking outside the box.
Yeah, let's expand a little bit more. So we're de-risking the transaction. The same thing happens today. Issuer picks their underwriter. The underwriter helps draft the prospectus with the issuer and company and underwriter counsel. They file it with the SEC, and then they go on the roadshow and they market. All that's the same, and they pick their syndicate and who they want to have participate. But as those orders get submitted and we populate the master order book, we end up coming up with this master order file. Okay, and if you just bear with us for a second. So this gets published publicly. This is on the public website. So investors see real time how the price and volume and demand is building real time. And you can see what's called the clearing price. And the clearing price is the highest price at which all the shares being sold can clear. So let's say it's a 5 million share offering and it can clear at $25 a share. There's people willing to pay higher than 25, but 25 is the highest price at which you can sell all 5 million shares. Now, what our algorithm does, and this is what the patents include, is the ability to discount the offer price a little below the clearing price where there's more demand. And then what we do is we have priority groups that basically say, okay, since there's more demand than supply, you can't fill everybody 100%. We're going to fill those allocations, if you will, at percentages that reflect the timestamp on the order. So if you come in early, Jason, and you stand still and you help build this price discovery, which gets disclosed and displayed publicly, you're going to get a higher allocation if your order's in the money. So if we price it, say 23, which is below the clearing price of 25, where there's more demand, everybody who bids 23 gets filled, guaranteed. And that fill rate is based upon your timestamp in the order. And the brokers are getting paid, they're working, and the investors know they have a fair shake, and it doesn't matter whether you are a widow and orphan or you're a major institution. Everybody has the same level playing field. And that's the way the secondary markets work. And it's the way the primary markets should work too. And Wall Street has managed expectations to think otherwise.
And one of the great things about that, to tag on to what Matt was talking about, is we now go back the way it used to be done, where everybody in the syndicate can go out and sell. That changed. Sort of now the lead manager takes all the orders and you're not really incentivized to sell. We go back, we make sure every salesman, so you might have 10 investment banks on that cover for that IPO, they can all actively sell now and get a designation. And the other thing we do is, by opening it up to all of retail, and who come through and they have to be on the cover, but you could have somebody like, you could have Fidelity, but you could have an Apex, which is SoFi's and the Robin Hoods. That's 25 million plus retail investors who can now participate, and their advisor or RIA is out there selling the deal. So you have anywhere from hundreds to thousands of salespeople selling your deal. And we can talk about this a little bit later. That goes back to what your company does. And if you think about that with the Reg CF, some of the issues with CF deals are there's nobody actively selling them. If you can have support, you can have somebody who writes you an article or a research report, or you've got a firm like DNA that's out marketing it, you're selling the deal. We bring all of that in our platform so you get the best of it, and you have a lot of people actively selling your IPO.
That's absolutely what's missing with Reg CF, regulation crowdfunding, as well as regulation A+, tier 2, is that secondary market. If a private company is using regulation A+ or Reg CF, the investors have that question mark of, when is there going to be a liquidity event? I don't have a place I can, sell this tomorrow. If a Reg CF issuer is tuned in right now, regulation A+ issuer, some of the clients we've worked with have over 50,000 investors at this point. When is it the right time for them to speak with you? When should they start looking at that secondary market creation? And, if it fits their strategy and model, of course, an IPO.
Well, there's no substitute for, quality companies. So I think when I was back in my Smith Barney days, and we built what was called the broker referral program, it was out with the 2,800 brokers west of Mississippi that I would court and say, hey, look, if you have clients that want to go public or do a private placement or do an M&A transaction, refer to us in the corporate finance side. And the brokers inevitably would throw anything at us. And I said, look, you need to step back and say, is it something that you would buy? Is it something that if we were to package it up and it was an IPO that you would buy? And if it is, then show it to us. If not, then, don't waste the time. But at the end of the day, back to your point, Jason, it's got to be a company that does qualify to be a public company. Now, it doesn't have to be a large company. It doesn't have to be a unicorn. It doesn't have to be a hot company. It can be, look at Medline that just went public. It was kind of a sleeper, but a good cash flower. And the deal was sized up. It was traded up 40% on the IPO, et cetera. But, it wasn't one of these, sexy AI companies. And I don't think you have to be that. I think you just have to be a good fundamental story, and getting beyond this Reg CF or the Reg A to the next step is, an IPO. And quite frankly, being able to file an S1, a Form S1 versus a Reg A, that's going to require a higher standard too, because you have to have a public company accounting oversight board audit. And that's, they make it a little bit difficult from a compliance and regulatory standpoint to be public. But if you can afford to get past some of those requirements, and it's a good fundamental story, man, bring it on. Because I think there's going to be more companies going public that want to access the public market to your point, create that secondary market liquidity and trigger that. And not only are deals, sold, they're not bought, but also an IPO is a financing event. It's not a liquidity event. So you have to recognize, if you're looking for growth capital and you want to maybe deep leverage your balance sheet or something like that, that's an appropriate approach. If you're looking for just going out and creating a huge liquidity event and everyone's heading for the door, that's going to be a tough sell, because the big institutions and generally investors don't want to buy shares in a company that the insiders are heading for the door. So it's a balance with all these things. And we're happy to be a sounding board and go through it with anybody that wants to talk about it.
And the creation of the regulation crowdfunding, I think 2012 or 2013, it was a great start, right? And it allowed people that have never been able to invest because they don't have enough money for private equity or VC funds, and it opened up to everyday investor. And for a lot of people that need cash to come up, to fund their great ideas, and you go crowdfunding and Reg A's, Reg D's, we're the natural extension. When people are ready to go to the next step, and a lot of the Wall Street firms have sort of forgotten about small cap and mid cap companies and deals. We think, we've talked to some recent of our colleagues who are out there in another firm. We think there's thousands of companies out there that are opportune, ready to go to the next step. And we think our platform will be that. And we think, we want to work with clients who are, we can refer clients to people in crowdfunding where hopefully they'll think of us when they're ready to move to the next step. And we're that natural bridge.
Absolutely. I think about microcap conferences I've been to, and, research 7,000, 8,000 some odd companies at that tier of public organizations. And what we do on the marketing side, whether it's a Reg CF or Regulation D to accredit investors, Regulation A+, we're targeting investors, bring them down marketing funnels. I find most of the groups I speak to are undercapitalized. So a few things to point out. Matt, you were mentioning, it's about that good story. Good deals are sold, not bought. Definitely speaks my language and what we're putting together with marketing funnels, as well as how we're targeting the masses with advertising and outreach. Very calculated based on what people have in their portfolio. But whether I'm speaking to someone at a microcap conference, whether it's a solopreneur doing a Reg CF or a company of 200 employees doing a Regulation A+ campaign, their investor network is typically limited. So being able to bring in more prospects beyond just the groups they're going after, beyond a few high net worth individuals, but retail, and be able to be able to have a more sustainable ecosystem in the trading and the secondary that occurs from there, but all around that large, landmark financing event. I think it's, just a huge opportunity for the space. And I love the, democratization aspect where it's, hey, we're bringing more people in. And so it's effective for all sides of the table.
Yeah, the other thing is, I mean, in the old days, you had the four horsemen who were bringing these, technology companies public. I think, Microsoft was a $35 million IPO, and you had the secondary market support with sales, trading, research. Today, the research model is broken because it's mostly in-house, but there's this need, like you said, Jason, to create this awareness factor. And what you're doing out there with DNA is making these opportunities available because people become aware of it. And then there's this follow-on secondary market opportunity to bring back ways with which to cover these companies and provide information. And I think in many respects, as we see a broader and deeper market evolve with this, hopefully, next economic cycle and demand for capital, because there's certainly going to be a lot of manufacturing, construction, building, and everything else that's going on, that requires capital. So being able to get out there to the market at large and inform investors about a particular investment opportunity and let them make the fundamental assessment as to whether it's appropriate, but create the platform and the method and the opportunity with which to broadcast those, and then basically leverage it. And this is where we think we can really scale once we get a couple deals done. I mean, this will be just it's highly replicable and it's highly scalable because it's all predicated upon existing infrastructure that's tried and true and works every single day. And we're just following the same pathways, but opening it up to everybody to have that opportunity.
And then when you think about it, if you think about what Matt just said and you look at today, when they take a deal, a company goes public, they're marketing to anywhere from between 200 and 300 firms, really. The same firms or the same people that participate in all the deals. A really hot deal, it might grow to maybe 350, 400. When you really look at a platform like ClearingBid, just with one of our partners, if you think about Apex, they bring 25 to 40 million retail investors. I think Schwab is 40 million. You go to the LPLs. I mean, there's a chance for companies to be able to get in front of millions and millions of investors that's never happened before. And our platform can track. I mean, we could have, TikTok could have gone public through our platform and we could have tracked 15 million individual orders, have everybody time-stamped in a priority bucket, and gotten a true democratic, fair, transparent opportunity to invest.
Yeah, optimize the price and mitigate the execution risk and put it in the hands of the people that really want to buy, own, and hold for the long term, which is good for the issuer, it's good for the investor, and it's good for the markets. And the regulators love it. They really do embrace what we're doing.
And master order flow of 15 million some odd investors in some of these cases. And definitely point out how it's applauded from each of the different groups in the ecosystem, like you're saying, the regulators, the Schwabs, all of the different brokers, everyone who's involved. Really applaud what you guys put together, and could see more of the groups coming from the investment crowdfund space maturing into that IPO stage. And that's what I really hear when I think of ClearingBid is more successful IPOs, IPO network. It took a lot of work to put this together. Just wondering what some of those, whiteboard discussions look like, and based on your backgrounds, building ETFs, even Navy SEAL, that must have been some very disciplined discussions all the way throughout. What recommendations would you guys have for founders who are tuned in right now in terms of what to test towards their growth? This could be, around business formation and what you guys have done on the entrepreneur side. This could be around capital formation and a successful IPO. But what would you encourage them to be doing right now after listening to this episode?
Well, you definitely learn on the fly when you go from the corporate world to becoming an entrepreneur, and it really comes down to the team and the people. I mean, Kayle and the team that we built, it was instrumental in helping us get to this point. And it's a collaborative effort from a technology standpoint, operational standpoint, marketing standpoint, certainly execution standpoint. So that's fundamental. Then obviously you have to raise capital to do this stuff. So, the initial funding kind of came personally, mostly friends and family, that we tapped through a couple different rounds, convertible note, then basically a first seed preferred round. But we did do a crowdfunding 2 years ago, a little over 2 years ago, for 5 million. We went for the limit here, and fortunately, we were successful. We got it done in less than a month with 3,700 loyal investors, and we had some sponsorship to help do that, which was really helpful too. But at the end of the day, that was an epiphany for us, because it showed what kind of sediment exists out there for what we're doing for our mission. And quite frankly, it's taken longer to kind of get to where we are now. Again, we're bucking up a little bit against the status quo on Wall Street to do what we're doing. And until now, the IPO market really wasn't there with any real great momentum. And by the way, we're not just build this for IPOs, but also debt. But that 5 million took us a long way. And but it's the money goes fast too. So you got to be very prudent with how you use your resources, the vendors you use, and the people you partner with. That's another area, Jason, that I think you really have to take a hard look, because some folks have a real partnership approach with what you're doing and have an affinity for what you're doing. And others, you just got to manage and make sure you're getting everything you can out of them. But, it's not the same kind of spirit with which you're going into these things. So, we're going through a transition right now in terms of how we're plugging into Wall Street compared to what we were doing before. I think it's going to be a much more scalable, reliable, secure method. But you learn as you go, and so you got to be open to advice. The team's input is really important. At the end of the day, the buck stops at one level, but you got to be able to sort of assimilate a lot. And Kayle can reflect on this too, because he's been there in the trenches with me doing it.
And you, first, and I wouldn't be there if it wasn't for you, Matt, to invite me to partner with you and give me this opportunity. But
Thank
think about it, you have to have perseverance, right? There's going to be a lot of times you don't get discouraged. If you have a great idea, you have a great product. It might take some time, and if you think it's going to take 12 months, it's going to take 24 or 36. And when I joined Matt, it really said this is herding cats. I mean, we've been working with getting 5 different constituents to agree to something that's revolutionary and goes against what's been done for the entrenched way of doing it. But we're getting there, and we have some great partners. And if you find the right people, they'll help it make it happen too.
Both
Here,
pointing at the importance of good partnerships, vendors, internal team members, upper management partnerships, you gentlemen, of course, the right systems to make sure that whether someone has the affinity, whether they have the passion for what you're doing or not, that they're still delivering. People are people, making sure that they're doing what doing what they say, and that the perseverance is there all the way through, along with conservative projections. What could take 12 months, you should probably plan for 24. What could take 2 million, if you're able to raise five. I want to point out, by the way, $5 million on a Reg CF, and from 3,700 investors, you are an outlier. Last year, there was 1,408 Reg CFs, five hit 4.8 million, let alone 5 million. So, decimal of a percentage. I think it speaks very loudly. The fact that you guys were able to do that shows what you're doing in the public markets as well. Optimization. I don't want it to sound too easy for anyone who's listening in, viewing. How do you manage something to a point of effectiveness? How do you make those transitions so that you're reiterating the product so it's a better fit for Wall Street and the partners you're servicing? How do you optimize?
I tell you, a big chunk of it here is the sales effort, because you got to convince people who are in many respects so set in their ways, and we respect that, because you can't change things overnight. We're taking the approach that this is an alternative. It's not intended to usurp or replace the methods of today, because you're just not going to break the cabal in the status quo. But so the selling effort is critical, and then obviously you got to draft behind that with the deliverables. And so fortunately, we built, we tested, we deployed, we proved, we did end-to-end trades. We had our first IPO ready to go and file with the SEC, which got put on hold really because of market conditions, not because of us. And so that again, you learn by just being out there and having to fight the good fight. So but back to that point about perseverance, and I think the sales side, that's and be flexible to know when you're making mistakes, that if you have to pivot, you got to do it, and make sure you're thinking ahead, make sure you're anticipating. I think that's probably the operative word I would use, is anticipation all along the way. You got to try to do that.
I've heard recently that should be looked at, managing a business almost like playing a game of poker, where you have to be understanding of, you're given these cards, you have to deal them, you have to manage with what you're dealt accordingly and not be too emotionally tied to it. That's what I'm
Yep.
thinking, as you say, flexibility as well as anticipation. What could come next internally here? What could come next on the other sides of the table? And really being able to gravitate towards what's working.
You also need to be able to pivot, right? Because you may think that you have a target in front of you and there's something that pops up that needs to be done before that, or takes precedence, or that sort of cools off and another fire pops up that has to be done, that's out of the sequence that you thought. So you have to have a team that's willing to be a little bit, malleable and be able to work together, and you can pivot to take care of what needs to be done.
Yeah, because we've tried to anticipate. I mean, people looked at what we were doing originally and say, well, the IPO market is highly cyclical, and it goes in cycles here, and we respect that. And so we happened to hit at a point when we were a down cycle, but we planned for that. So we structured another feature, which is the ability to do debt off the offering platform, and that really doesn't require the same kind of algorithm to underprice an issue, but rather try to lower the interest rate or the coupon that an issuer is paying, but allow this broader universe of investors to be able to invest in, bonds. And so we've really kind of tried to hedge our bets to the point of, okay, you have to anticipate where there's going to be some pitfalls and things that are out of your control. And in the market, for example, is one of the things that, just totally out of our control. So we have to plan for other ways to have contingencies. But I think we've done a good job of that. And now, within the next 6 to 12 months, I think it's the perfect storm right now, which fortunately we're really excited about. We're going to be doing another fundraising here to help give us some wind at our backs, but that'll come with an increased marketing effort. So
time in the market, like you said, and being in the right time of the cycle, not just looking to time the market itself, but having enough time in there, making the pivots along the way, hearing the feedback, making the shifts accordingly. What about scaling? 40 years on the street, 28 years on the street, 6 years putting everything together here, a successful capital raise and going from, million, 2 million, 5 million, which again, those are big numbers for Reg CF. I'm sure you'll be looking at larger rounds, larger growth metrics, but pulling from your past, your bios, looking at what's ahead, what recommendations, what tips, what examples can you provide to the audience around scaling? I would say it's part of everyone's, business plan. Here's how we're going to scale. What types of insights can you provide around that?
Well, I think as we've built this, we recognize that leveraging the existing infrastructure and how the securities industry, order pathways work and exchange technology architecture and everything we've kind of built around and upon, that's highly scalable. And we didn't want to have to come up with something from a technological and operational standpoint that was reinventing the wheel. It was just taking advantage of what's out there and doing a better job using it. So I'd say that probably the biggest constraint, and Kayle can chime in on this too, right now is going to be getting the right personnel on the team to be out there making the calls, educating the market at large. It's not just issuers, but it's, brokers, it's investors, it's working with the regulators. So I think, but we'll cap out at a certain level of headcount because I believe that the street is going to be selling for us. I mean, we're going to allow these middle market firms to move up the league tables, do more deals, leverage their sales force, rent the rest of the distribution to do more deals. So it's going to, I think, bring the middle market investment banks up. It'll allow the big investment banks to continue to do what they're doing, but it'll allow for greater participation. And back to your questions about scale here, Jason, is that with these fixed order entry pathways, the ability to, follow the same methods, it's tried and true. Also how settlement and delivery works. We follow those same pathways. So we're really not constrained by scale and capacity. Just to step back for a minute, when we were first getting going on this, the analogy was we're like a stadium and 95% of the time it's empty, but 5% of the time it's game time. That's like in the final stages when the pricing is taking place and then the ultimate, cancellations and allocations and everything else. And we have to be prepared. This is one thing we have to build for from a technological standpoint is we could get to the final pricing and all of a sudden there's this massive cancellations because there's maybe some extraordinary event or something happens. So we're just taking orders in one direction. It's not, a lot of back and forth bids and asks. It's building an order book, but we have to have that capacity, especially in the tailing end. So that's the one structural technological issue we had to build for, but everything else is highly scalable. And I think we've got a high degree of comfort that we're going to be able to handle that with everybody we're working with on the partner side and the vendor side and how we built this and the ability to test it and make sure it's going to work.
And the other thing about when you think about when I joined what Matt had built and Roland, this is not a product that we're out trying to put on shelves in a store and we've got to have this huge regional distribution sales force depending on the product. Our product, they built it, which is revolutionary to use an existing system called Fix. So it can take, as Matt said, from a stadium, we can scale from having a deal that's going to sell 5 million shares and you only need, 500 to 1,000 orders, or the ability to, and I'm going to say something here that people are going to say I'm crazy. We could help Elon Musk go public tomorrow. We could take 20 million orders. He could raise more than 30 billion and more than $1.5 trillion market cap because the market's going to tell you what that is. It's an auction and we're using existing technology. So we're leveraging that. Same with our distribution. We use the banks, so all of their sales force, they're out actively calling, but then we're going to use the beauty of like what you do. You use technology to develop your marketing plans for your clients. So we do that. We're going to be doing that. We're going to allow people like a SoFi to go out to their clients, their 12, 13 million who want to IPOs. And we're also hoping people come to ClearingBid and subscribe. And we don't want to take people's clients, but we want them to tell us what they care about. So when we have a deal, we can send them a push notice, and hopefully we'll have 10 million subscribers and say, there's a company going public in the space you care about. If you care, come to ClearingBid, take a look, see if your bank is on the cover. If not, see if they can get on the cover, or if you can get an account at SoFi, how you want to participate,
Mm.
and put a bid in.
Exactly. Ubiquitous.
With that existing audience, the push notifications, you have substantial volumes coming through, and with the right messaging, with the right story, of course.
And a very small, it's leveraging technology.
Yeah. Like you said, not reinventing the wheel, building it better for
Exactly.
more successful, better IPOs, better access for the investors. Love the analogies and some of the types of groups you could be servicing this for, and for different volumes. Really, really amazed with what you guys have built. And again, being involved with groups that are a bit earlier for the most part, seeing how they're going to transition to this and the needs for it in the market today.
I mean, the beauty of ClearingBid, and Matt might want to speak to this more, we could take a lead manager or a biotech, and traditionally they go to the biotech mafia, right? You could do that with our platform. You could say, we want to just go to people that invest in med tech or people invest in biotech, and you run an auction and you open up the same thing. So the market's driving the pricing, you're using the same system. And then you could do a deal the next day where you open it up to millions of investors.
Yeah, because the public portal is just the window to the market at large. I mean, they're going there, they're getting, the price and volume and demand on a real-time basis. They see the prospectus, they see the roadshow, they can communicate to their broker and, put their order in and see if their order's in the money on a real-time basis. So everyone's got a level playing field. It's completely and totally transparent. Today, the underwriters are reluctant to show that. They don't let you know what the pricing looks like. It's all
Yeah.
done behind the curtain, and it's highly discretionary and discriminatory and exclusion. It's exclusionary. So, this is where the internet is the great equalizer. And as Kayle mentioned, this is the one area of Wall Street that's so antiquated and opaque and behind the times. And it's time to get with it. And the market's there, and the public at large wants to see it, and we're going to deliver it.
Going to be rooting you on, going to be introducing issuers. As an investor, you're going to be watching groups that are launching publicly. Where could viewers, where could listeners go to learn more, start following you guys? And any final statements? I feel like that was a mic drop moment, as the kids say right there. But any final statements you want to leave the audience with today?
A couple things. One, appreciate the opportunity to share this with you today in the audience. ClearingBid.com is our website. We're going to be introducing here shortly our tutorial video. This took a little while to get in the can. There's a lot of technical issues that we have to cover in it. So it's our first foray into educating the market at large that we're coming and how it works and what we're doing. We've got a chat bot feature that will hopefully provide some customer support interface there that'll be doing. There's going to be no substitute for bringing our first deal, so we're working on that as we go. It looks like we're going to do another small round of funding right now, and we may be doing a Reg CF to do this. We're assessing it right now, which would be a lot of fun because we had a lot of success before. Kayle, any thoughts you have on kind of sense of urgency or the opportunity right now?
Yeah, a couple of things. One, come to ClearingBid, subscribe, register, we don't ask for intrusive information, but we ask for a little bit. It'll help us be able to deliver what we want to people, and we hope that grows. Over time, we have a thing called the Knowledge Hub that will expand, that will have things like research and news articles, and you might see things, forums, things like women's investment or teens investment to help educate. We want to also help educate. Podcasts, things like this would go there. And, there is a small opportunity now. We're hopeful some people will help us just get over the goal line. And, we're excited. We think there's a huge opportunity, and we want to be able to be in the market, sometime in Q2 of next year.
I'm so excited about what you guys are doing. Building a better IPO process. Like you said, it's been done the same way for decades, 100 plus years. You're able to build off of that, not just change it, but make it a stronger model and for everyone on all sides of the table. So thank you so much for taking the time to share with us here at Test Optimize Scale, viewers, listeners, about why you built it, what you're doing, the solution. Can't tell you how much we appreciate it, and that we're going to be following along and rooting you on and applauding as you hit each milestone here.
Great, Jason. Well, we appreciate it. It's great to see you. Hopefully we'll get out on the golf course here soon and we can commiserate even further. So this is a great opportunity.
And I just want to echo that. Thank you very much for having us on. We continue to, look to partner with you and look, to watch your business continue to grow as well.
Thank you so much. I appreciate that. And I'm going to take you up on that golf course invitation. Want to thank all the listeners, viewers for tuning in as well. We'll see you next time. Thank you. Take care.